So friends, today we are going to look at the RTP for May 26. A lot of students have been reaching out saying, sir, when you do a video on May 26 RTP. So here I am. Now this RTP rate I have gone through. There are quite a few questions which are similar. Most of them are actually similar to what we have solved in the past. But students still wanted me to solve this entire paper. So I am doing this for you. So let us go and have a look at it. I will go in the order of the RTP only. I will not be doing anything different. I will just go in the order of the RTP. We will solve the relevant questions and move forward. Okay, this is the RTP and I have copied it and kept it in a easier format so that it is easily visible. The size is bigger and all of that. Okay, so let us read the first question. Mr. Y is a risk taker. Okay, very good. He takes his positions in derivative market on a single stock through margin trading for 4 days. In a week, he does not take a position on Friday to avoid weekend effect and takes position only for 4 days in a week, Monday to Thursday. Okay, this is that VAR problem. He transfers the amount on Monday morning and withdraws the balance on Friday morning. He decides to take a maximum exposure in derivative market where value at risk should not exceed the balance lying in his bank account. So whatever is the value that is at risk should not be more than balance in bank account. The position by his manager as per standing instructions taken on free balance lying in the bank account in Monday. So whatever is the Monday morning balance on that is the maximum loss that he is willing to suffer. On Monday morning, before opening of the capital market, he has transferred an amount of 11 crores to his bank account. So he has transferred 11 crores. A fixed deposit also matured on this Monday. The maturity amount of 63,42,560 was also credited by the bank in the morning of the Monday. So he had opening balance of 11 or he transferred 11 and he had this 63,42,560. However, Mr. S received intimation of the same in the evening. Whether he received or not is irrelevant because as per the standing instruction, his manager will invest. The bank needs a minimum balance of 1,000 at all times. So out of this entire money, only 1,000 is maintained in the bank account. Balance is all invested. The other information with respect to stocks A and B, which are in consideration, is as under. A return is 6, 7, 8, 9, 10. Probability is there. B return and probability is there. Now, information given above, choose the correct answer to the following question. See, MCQs, if you recollect, we usually said first read the question and then go back to the paragraph. But in this case, I have done ulta because I've already realized that reading the questions doesn't make any sense because the questions are paragraph specific. Okay. Now, from the following information, choose the correct answer. The amount that will not be considered for taking a position in the Monday morning. What is not considered? Will not be considered for position. How much will not be considered? Amount that will not be considered for taking position on Monday morning. We thought that only 1,000 rupees will be there. No. So what they are saying is then 1,000 is not in the option also. So basically they are saying that don't take this. In this, please don't consider any amount for taking a decision because the details of which were not available. So here they are making an assumption that this entire amount is not going to be invested. Only 11 crores will be invested. So 63,42,560 is the only correct answer because you will invest 11 crores. You will invest 10,99,000. You can also invest 63,41,000. So the amount that you will not be considered is only this. Okay, now this is very different from the actual study material question that they asked, where they even taken this amount and only 1,000 is not considered. But here they are not considering even this amount also. Very, very weird answer. Okay, very weird answer. Which stock has wider dispersion? What do you mean dispersion? Measures of tendency and dispersion. Dispersion means standard deviation given on the probability distribution. A, B, both are cannot be determined. So basically you have to find out the standard deviation. What is the standard deviation formula? Standard deviation is equal to under root sigma x minus x bar whole square by n. But if this is probability based, then it is under root sigma x minus x bar into probability. X minus x bar whole square into probability. There is no by n. This is the formula. So what is x bar here? X bar is you basically multiply the 6 into 0.1, 7 into 0.25 like that. So I will call this A bar is equal to, I will do this here, 6 into 0.1, 6 into 0.1 is equal to m plus, 7 into 0.25 is equal to m plus, 8 into 0.3 is equal to m plus, 9 into 0.25 is equal to m plus, 10 into 0.1 is equal to m plus. Memory recall, you get 8. This is mean. 4 into 0.1 is equal to m plus, 6 into 0.2 is equal to m plus, 8 into 0.4 is equal to m plus, 10 into 0.2 is equal to m plus, 12 into 0.1 is equal to m plus. Memory recall, this is also 8. Okay, now mean is 8, but what is standard deviation? Standard deviation is you have to do for each one of them separately. So for this, 6 minus 8 whole square into 0.1, and like that you have to do sum for everything. So the difference is 21012. Okay, and here the difference is 42024. See, now looking at this itself, you can very clearly say this has a higher dispersion. Very, very clear. Why? Because the values are far greater away from the mean. See, the probability values are probably close by, but the absolute values, how far are they away from the mean? See, here you have 420, here you have 210. So mean is 8, but for B, the values are far away from the mean. So you need not actually compute the standard deviation also. Which has greater dispersion? Answer is B, stock B. This is stock B. Okay, very simple. You need not actually get into other details. Then, in value of risk analysis, which factor directly increases VAR for a given investment? When does VAR go up? Higher return, lower confidence level, higher standard deviation, or shorter holding period. So, in case of VAR, what is VAR wala formula? It is Z value into standard deviation, Z value into standard deviation into value of portfolio. Right, this is the formula. Okay, so now in this, does return have anything to do with this? No. Confidence level, if it is lower the confidence level, VAR will actually be lower. Okay, here they are asking increase. Then higher standard deviation, yes. If standard deviation increases, then value increases. Okay, so because if lower the confidence level, lower the Z value. Okay, then shorter holding period. Okay, so holding period is root T. So into root T. So if value is, the holding period is reducing, then the VAR will also reduce. So here the answer is C, higher standard deviation. Then, since Mr. Y invests in derivative of a single stock, not a portfolio, the risk considered for VAR is diversifiable, unsystematic, total, or market risk. So first of all, derivative is a single stock. Yes, understood. Not a portfolio. Okay. The risk, is the risk diversifiable? Yes, the risk is diversifiable. Is it unsystematic, or is it total, or is it market? See, here I don't think we are looking at unsystematic risk only. This is definitely not the answer. It is sort of a diversifiable risk, but when you look at the standard deviations of the stock, no, you're actually looking at the total risk. When you're looking at standard deviation, right, because here we took the value of standard deviation. Standard deviation is total risk. So it is total risk. It is not diversifiable or market risk only. It is total risk. So the answer for this is C, total risk. Okay, slightly interesting and twisted question, right? Okay, let's move forward. Next question is also on MCQs only. This is Forex. An Indian exporting firm, Radhe & Sons, exported dry fruits worth AUD 1 million to an importer in Sydney. Radhe & Sons are worried about likely depreciation of AUD in near future, and it is likely that the export sum will be received after 3 months. Today, as such, there is no derivative contract that is available in AUD to hedge itself. Given the following data, spot rate is 64 rupees per AUD. 3 months interest rates are as follows: deposit rate and borrowing rate for rupee and AUD. From the information given above, choose the correct answer to the following question. What kind of hedge is this? This is a money market hedge. So, in a money market hedge, see, there's the first line. For foreign currency receivable, the exporter should do what? See, what is happening? What is the logic here? I am Indian exporting firm exported something somewhere. So, in future, I am going to get AUD in. When I am going to get the AUD in, when I do a money market hedge, what will I use that AUD, whatever I am getting after 3 months to do? In a money market hedge, you have a deposit and you have a borrowing. So, if I am going to get foreign currency inflow, then I will actually take a foreign currency borrowing now, so that the inflow can pay off the borrowing. So, what is the question? Money market for foreign currency, the exporter should borrow in foreign currency and invest in domestic currency. This is the correct answer, because when you borrow in foreign currency, on the due date, foreign currency is payable. Where are you going to get the foreign currency from? From export receivable. So, the answer for this is B. So, the answer for this is B. Very simple. In case Radhe & Sons adopts money market strategy, the interest rate used to compute amount borrowed. So, if you are going to borrow AUD ke liye, what is the borrowing rate? 5%. So, you will use 5%. 5% per annum. B. 5% per annum. B. In a forward contract, if AUD were available, the money market hedge would be always be superior, inferior, be compared with a forward hedge for efficiency, or becomes invalid. So, you can never say whether the forward will be better than money market. Ideally, they both should give you the same thing. Otherwise, there should not be any arbitrage opportunity. So, it will always be compared with forward hedge. The money market hedge will always be compared with forward hedge for cost efficiency. So, answer is C. Then, interest rate parity theory assumes no capital mobility, no. Presence of arbitrage opportunities, efficient markets with no arbitrage opportunities, and fixed exchange system. See, there is capital mobility, If there is interest rate parity, then there is no arbitrage. So it assumes that the markets are very efficient and you don't get any arbitrage opportunity. So the answer is C. It doesn't assume that there are arbitrage opportunities. There may be an arbitrage that may arise if interest rate parity theory does not hold. Okay, so the answer for that is C. Okay, now we have finished the first two questions. Let us move to the next one. Advanced capital budgeting decision. This is not a theory question, this is a practical question. Tension-free Solutions is a reputed logistics service provider. All the deliveries are made by drivers of the mini trucks. The company employs many drivers, each of whom is provided with smaller trucks to make deliveries. Each driver drives approximately 40,000 kilometers per annum. It decides to continue its present policy of buying a new truck for its drivers, but wonders whether the present system of replacing it every 3 years is optimal or not. It is of the belief that the new models are entering into market on a yearly basis. It wishes to consider whether a replacement of either 1 year or 2 years would be a better option than present 3 years. The fleet of truck is due for replacement shortly in near future. And the purchase price of the latest truck is 5,50,000. The resale value of used truck is as follows: 1 year, 2 year, 3 years. Running and maintenance expenses excluding depreciation. So basically only cash flow are you have 30,000 for year for road taxes. Then petrol and maintenance is 3 lakh, 3 lakh 50 and 4 lakh 30. If you add both of these, you get 3.3, 3.8 and 4.8. Using opportunity cost of capital of 10%, you are required to determine the optimal replacement period for the truck. Now, this is optimal replacement period. So, how do you do optimal replacement period? See, in fact, there is, I think, a very, very similar question in our study material. There is a very, very similar question. And how did we solve it? I think we solved it using EAC, equalized annual cost. So, let us do the same thing. I have the question in front of me here. EAC. Okay, first let us put all the total cost. Replacement year 1, 2, 3. Then costs, tax plus petrol. We had these two numbers right here. I wrote them down also. 3.3, 3.8 and 4.8. Okay, this is the second part. Then what else data did they give? What is the cost of the truck? Sale value is there and cost of the truck. Cost of the truck is 5.5 lakh, sale value. Resale value. How much is it? They gave some resale value number, no? $3.5, 2.1 and 9. Now, please note these are at the end of 1 year, 2 year, 3 years. Okay. So, this cost for the first year and you get this is the resale value. Then cost of new truck 5.5 lakhs. In all cases, it is 5.5 lakhs. Whenever you replace, it is 5.5 lakhs. Now, you see, if you are going to replace after first year, what is the equalized annual cost in that case? See, you will incur some cost. What will be the cost that you incur? Replacement year 1. So, cash flow 3.3 minus 3.5 lakhs, which is 0.2 lakhs. Present value of cash flow. What is the present value of cash flow? 20,000 divided by 1.1. You get 18,181. Okay, and this is minus. Okay, this is minus. The reason why this is minus is you are incurring 3.3 lakhs, but you are also getting back 3.5 lakhs on resale. Okay. Now, on day 0, you are actually getting a benefit. Now, let us take replacement year 2. Okay. So, what is the cash flow that you incur? See, first year you incur 3.3 lakhs and present value of that is how much? 3.3 divided by 1.1. You get 3 lakhs as first year expense. Second year, you incur 3.8 lakhs. So, 3.8 divided by 1.21 because you have discounted for 2 years, 3.14 lakhs. Okay. And second year, you can sell it for 2.1 lakhs. So, 2.1 divided by 1.1 square, you get minus 1.7355. So, plus 3.14 plus 3. What is the total expenditure that you have incurred? Everything is from a present value terms. You get 4.4045 lakhs. You get 4.4045 lakhs as the expenditure that you have incurred over the 2-year period. Okay, now I'll come to this. I'm leaving the problem halfway only. Replacement in year 3. 1, 2, 3 and 3. You'll have 3 things. Expenses 3.5 lakhs, no, or 3.3 lakhs. What is it? 3.3. Then second year is 3.8. Third year is 4.6. See, I wrote 4.8, it should be 4.6. 4.6 and resale is 0.9. What is present value? 3.3 1 year present value, we figured it as 3 lakhs. Then 3.8 we figured it as 3.14 lakhs. Then 4.6 divided by 1.221. 4.6 divided by 1.1 is equal to 1, 2, 3 is 3.456 and 0.9 divided by 1.1 is equal to 1, 2, 3 minus 0.676. So 3 plus 3.14 plus 3.456 minus 0.676. You get 8.92 lakhs as the spend that you do in present value terms. Now this is the spend. Now if you look at this, right? What is happening here? This is the total spend that you have made over 1 year. But you also spent, okay, and this is the present value terms. You also spent 5.5 lakhs on day 0. Here also you spent 5.5 lakhs on day 0. Here also you spent 5.5 lakhs on day 0. Right. So you can actually do EAC only for the cost, or you can do EAC including the cost of the machine or cost of this whatever truck. Right. If you do EAC computation, so EAC purchase price, other costs, 1, 2, 3, a replacement period. This is 5.5, 8.92. This is 5.5, 4.4045. Okay, now, so total cost. So 5.5 minus 0.18181 is 5.31819. 5.5 plus 4.4045 is 9.9045, and this will be 14.42. Now EAC. EAC, how will you do? Present value annuity factor, present value interest factor annuity for year 1, 2, 3 at 10%. 1 by 1.1 is equal to 0.909. 0.909 is equal to, and GT is 1.7355 and 1.1, 1 by 1.1 is equal to 1, 2, 3 GT. 2.487. Now EAC is equal to, for 1, 2 and 3. See, it is very apparent for the first year itself is the correct one. Okay, but anyway, I am doing 5.31819 divided by 0.909. 9.9045 divided by 1.7355. 14.42 divided by 2.487. Okay. 5.31819 divided by 0.909, 5.85060, 9.9045 divided by 1.7355 is 5.70700, 14.42 divided by 2.487, 5.79815. Array, I thought that the first one will be the lowest equalized annual cost. No. The second one has better equalized annual cost. Second one has better equalized annual cost. So you see what they have done. If you just consider this one value alone, no, you're not getting the right answer. You have to consider both of them and then you arrive at the equalized annual cost. Then you will get the right answer. Okay, it is not a very simple straightforward thing. The reason why they did it like this is to tell you that in second scenario, it appears that other costs are high, but when you equalize them over a period of time and arrive at it on a present value basis for 1 year, that is year 0, you get that as the lowest cost. So you should replace at the end of year 2. That is the solution. Answer is replace at end of year 2. Okay. Now I have taken here rounded, I have taken here lakhs. If you go and solve this in exact number, you will get a slightly different answer. You will, in 4th decimal, 5th decimal here, whatever I have, you get a different answer. You can solve that way also. And I think institute material is given that way. I suggest you solve actually that way. But here the logic is you have to, I am trying to explain to you the logic. On decimal point, if there is a slight variance, kindly excuse. But if you have understood the logic, I think you can go ahead and solve it. Now let us move to the next question. Next one, let us go to this chapter called security evaluation. The data given below relates to a convertible bond. Acha, this is a convertible bond question. Face value 1000, very simple. Coupon rate 12%, I know. Share number of shares per bond. So per bond you will get 20 and current market price is 48. Straight value of the bond, that is if you exclude the conversion option, value is 940. Then market price of the convertible bond. Because there is a conversion option, its price is 1060. Straight price is 940. So value of the option is 60 plus 60, 120. Okay. What is the stock value of the bond? Stock value of the bond is very simple, no? What is the component of the stock? So basically 20 into 48, 960. Stock value of the bond is very simple, 960. So solution, stock value is equal to number of shares. We shouldn't use the short forms, I am more used to the short forms, is equal to number of shares on conversion into current market price per share. That is equal to 20 into 48, that is equal to 960. Okay, first one is over. Then downside risk, percentage of downside risk. Now downside is always from top. What is the top value here? You have market price of the convertible bond is 1060. It can fall down. Fall down to what level? If nobody chooses to convert, it will, ideally, you'll repay the face value. But as on date, if the value of the stock is coming down to 0, then the straight value of the bond is what you are theoretically liable to pay. You're liable to pay 1000 when you repay the entire sum. But as on today, given the current yields, the value of the bond is 960. So downside risk is equal to 1060 minus, not 960, 940. 940 is the straight value divided by 1060 from where it is falling. So which is how much? 120 by 960 by 120 by 1060. That will be 11.32%. Now our CA Institute has also said that it can be compared as 120 by 940, which I don't agree with, because that I don't think that is sound logic. Downside risk is from top, it is not from the bottom. Okay, so this I don't agree. I mean, this they have given it as 12.76%, but that is not something that I am very comfortable with. Downside risk is from top, where it will come down. Okay, then conversion premium. What is the conversion premium? Current market price minus market price of equivalent shares divided by premium. Premium again is from bottom. Premium again is from bottom. The minus market price of equivalent shares. That is 1060 minus 960. Why 960? Because equivalent shares value is 960. By 960, that is 1000 by 960 or 100 by 960, that is 10.4166%. Okay, then what is the last one? Conversion parity price. is equal to 1060 by 20. At what price of share will the will it be equivalent? At what price of the share will the value of the shares that you get be equivalent to the current market price of the bond? 1060 by 20. It will be 53 rupees. The conversion parity price. That's all. Over. Nothing else. Then. So let's go to the next question. This is also same chapter. Mr. A is thinking of buying shares of 500 each, having face value of rupees 100. He is expecting a bonus ratio of at the ratio of 1:5 in the fourth year. Annual expected dividend is 20%. The same rate is expected to be maintained on the expanded capital base. He intends to sell the shares at the end of 7th year at expected price of 900. Incidental expenses for purchase and sale of shares estimated at 5% of the market price. He expects a minimum return of 12%. Should he buy the share? If so, advise the maximum price. Assume that there is no tax on dividend income. Present value factor should be used up to 3 decimal places, and final calculation should be rounded off to 2 decimal places. Now, this is a question. I think this is also there. I have solved this in the class, but anyway, let us go ahead and solve this. No, it's nothing major. It's a very simple. I have opened this here and kept it so that I have the question in front of me. I don't want to scroll every 2 minutes. See, first thing, incidental expenses for purchase and sale are 5%. So he's thinking of 500 shares each having face value. How many shares is he buying? We don't know. Okay, let us assume that only one share. Year cash flow 0. 1 into minus 500 into 1.05, because if you purchase 500 rupees worth of shares, he has to also spend 5% of the price as cost. So 5 5 is 25, so minus 525. Okay, present value factor 0, and he is at 20%, at 12%. It's not 0, it is 1. Okay, at 12% is 1 for year 0. Present value of cash flow is minus 525. Okay, then year 1, what happens in year 1? They said is expecting a bonus during the 4th year. Okay, 4th year mein 1:5 bonus, but for every other year dividend is 20%. 20% of what? 20% of face value of 100. So if you buy one share of 100, you get 20 rupees as dividend. So plus 20 and 1 by 1.12, which is 0.893. So 20 into 0.893 is equal to 17.86. They said final answer 2 decimal, present value factor 3 decimal. You do this for during the 4th year. So till 4th year, see, 2nd year, 3rd year, he gets the dividend. 4th year, beach mein, somewhere in between, he gets the bonus. So 2nd year, 3rd year, and 4th year, what happens? He gets this 20, but 1:5. So for every 5, 1. So if he has 1 share, he will get 0.2 shares, right? 1 by 5, right? So into 1.2, that is, this is 24. So 24 is the dividend that he will get. Now 1 by 1.12, 1, 2, 3, 4 is 0.636, 5 is 0.567, then 0.507, then 0.452, then 0.40, then 0.452, right? Now this 24 dividend, no, how long will he get? He will get for the next 3 years. 24, 24, 24. In the last year, he is selling it off at some price. We will come to that, what price he is selling it off. But first, let us find out this value. 24 into 0.636 is equal to 15.26. 0.567 is equal to 13.61. 0.507 is equal to 12.17. 0.452 is equal to 10.85. Okay, and in the last year, it is not 8, it is 7. In 7th year only, he is selling off. He is told here, right? In 7th year, he is selling it off at a price of 900. But how many shares is he selling off at 900? He is selling 1.2 shares at 900. Because he's got dividend, no? Right? Then, once he sold it off at 900, there is a reduction in cost. What? Incidental expenses. So he is only going to get 1 minus 5%. So if you look at this, 900 into 1.2 into 0.95. So he is actually going to realize only 1026 rupees. At what rate? Present value factor into 452 into 0.452. That is 463.75. Now let us look at the total. What is the present value? 17.86 plus 15.94 plus 14.24 plus 15.26 plus 13.61 plus 12.17 plus 10.85 plus 463.75. Add all of this, you get 563.68 minus 525. Right? So minus 525. You get NPV as 38.68. Now, what is a specific question that they asked? Assume there is no tax on dividend. If so, advise the maximum price he should bear. Should he buy the share? If so, advise the maximum. What should he buy the share? Yes. NPV positive. So, buy the share. Max price is equal to is when NPV is equal to 0. Implies purchase price including cost is equal to 563.68. That is, see, 525 is the purchase price that we subtracted, present value. So if 525 increases to 563, NP will become 0, no? So you have to compute that. That is purchase price before incidental expenses or cost is equal to 563.68 by 1.05. You get 536.84. So this is the answer. Is there anything else that they have asked? 536.84. That's it. They have not asked anything else. So this is the solution. Okay, let us go to the next one. Let's go to the next question. And this is from business valuation chapter. The following data pertains to XYZ Inc. engaged in software consultancy business. Income from consultancy, EBIT, interest, EBT, tax and PAT. Balance sheet. Equity stock 10 million at $10 each. This is all in $1 million. Okay. Reserve and surplus, loans, current liabilities. Land and building, computer software, current asset. Okay. Total and total. Okay. Then with the above information and following assumption, you are required to compute EVA, MVA. Assuming that WACC is 12%, the share of the company currently is quoted at $50 each. Now, what is EVA first of all? This is a very easy question. Economic value added is what? Is equal to no PAT minus capital charge. No PAT is equal to EBIT into 1 minus tax rate and capital charges WACC into capital employed. Now, what is EBIT here? Do we know the EBIT value and do we know the WACC? WACC they have said 12%. Okay. Then what is EBIT? EBIT is 180. So 180 minus 35%. 180 into 1 minus 35% minus WACC of 12% is to capital employed. What is capital employed here? Capital employed is net of working capital. So if you remember this, equity plus debt. This current liabilities has to go there. Current liability is how much? 180. So 785 minus 180, or you can take it 180, you can subtract it here. So capital employed is equal to equity plus debt. 785 minus 180, is it 705 or 605? It is 605. Okay, don't get that confusion. 605 into 605. So 180 into 0.65 is equal to 117 minus 605 into 0.12 is equal to 72.6. So the net is minus 117. You get 44.4. This is your EVA. Okay. Then what is the second question? Market value. What is market value added? Market value added is equal to, what is market value added? Market value added is market value of equity plus debt minus book value of equity and debt. See, in our case, market value of debt and book value of debt both are same. But anyway, we'll do this. What is market value of equity? We have 50 million shares or something, no? How much? Of $10 each, not 50 million. 10 million shares of $10 each, and each share is $50, I think. Yeah, 10 million into 50. Market value equity. 10 million into 50 is equal to 500. Debt is how much? 180. This is 680. Book value of equity and book value of debt. Book value of debt is 180. Book value of equity is 100 plus 425, 325, which is 425. So this will be 605. So market value added is equal to $75 million. Okay, next question. So friends, now let us go to the next question. This is from derivatives chapter. Following is information available pertaining to shares of Omni. Current market price 840, strike price 900, maximum price 1050, minimum price in the next 3 months 756. So basically this is the binomial model wala question, or risk neutral. Continuously compounded rate of interest is 8%, e power RT is 1.02. Based on the above, calculate the value of 3-month call option using binomial and risk neutral. So both are different. Please remember, we have done some problems in the class where we said both are different, and also draw a conclusion, round off calculations up to 2 decimals. Basically, what is the conclusion they want you to draw? Basically, are you going to get the same answer under both? Theoretically, technically, logically, everything you have to get the same answer. You cannot get a different answer. So now let us go ahead and solve. Very simple question. There is, I think this question came in November 24 or one of those attempts. There was a very similar question where they said solve using both of them independently and show that they both are the same. I think it was May 24. I don't recollect exactly which attempt, November or May, one of those attempts. Okay, so let us go ahead and look at this solution. First, let us calculate the value of 3 months using binomial and risk neutral. See, when we say binomial, right, what are the methods that you can use? You can use delta hedging, or you can use a replicating portfolio. You can use one of them. I will use only one. I will not use two. If you have if you have time, you can use both. Okay. Risk neutral is what? Risk neutral is our probability is equal to e power RT minus D by U minus D. Okay. So first, binomial method. Now in this, right, if you look at the RTP solution, no, they have used e power RT wala formula for your binomial model. That is not correct. Okay, in binomial model, you have to use either the delta hedging or portfolio replication. And binomial method is not binomial tree. Okay, binomial tree is drawn using which you can use any of these things. Okay, so let us use one of these methods. Let us take delta hedging. What is delta? Delta is equal to change in value of option for change in value of share. If you draw a binomial tree, what is happening here? Just opening the thing here and keeping it so it is easy. 840, 1050 and 756. 840, 1050 and 756. What is the thing? 756 divided by 840. This is 90%. And 1050 divided by 840 is 125%. Okay, it goes up by 25% and comes down by 10%. Right, strike price is equal to 900. Correct? No? Yeah. So value of option, and this is a what? Bicol only, no, not put or anything like that. 3-month call option. Correct. If the strike price is 900, the value of the option is 150 here. The value of option is 0. So change in price of the share is 1050 minus 756, basically 294. So delta is equal to 150 by 294. That is equal to 51.02%. So 51.02, or you can say 0.5102. Okay, that's a better way to say this. So what is this point? So if you sell a call, you have to buy 0.5102 shares so that the portfolio is fully hedged. So invest or buy 0.5102 shares and sell a call. Okay. Now, if this portfolio generates risk-free returns, that is what is the logic. What is the logic for our delta hedging? If portfolio generates same return, okay, same return on up and down, then it is a risk-free portfolio. What is the value of the portfolio? Value of portfolio on day 0, 0.5102 into current spot is 840, right? Into 840 minus call. Okay. Value of portfolio on up 0.5102 into how much? 1050. And what is the value of the call option? Value of the call option is 150 because you have sold a call. Okay, value of the portfolio on down 0.5102 into 756 minus 0. Now, what is the value of this 0.5102 into 1050? 0.5102 into 1050 gives you 535.71 minus 150. You get 385.71. If you do 0.5102 into 756, what is it? Correct, same thing, 385.71. So this particular portfolio, whether the stock market goes up or the stock goes up or down, if you have a portfolio of the delta shares and you have sold a call, the value of the portfolio is same. So this portfolio generates risk-free return at 8%. Okay. Now they have given e power RT value. We will come to that. So what is value of portfolio? On day 90 is equal to 385.71. Present value is equal to 385.71 divided by e power 0.08 into 3 by 12. Okay, that is 0.02. That is 385.71 divided by what is e power RT value? They gave something 1.0202. So present value is equal to 378.074 PV of portfolio, and present value of portfolio on day 0 is equal to how much? We have a number here, right? Day 0, 0.5102 into 840 minus C. So 0.5102 into 840 minus C, it should be equivalent to 378.074. Why am I saying this? If there is a portfolio which is, despite volatility, is remaining the same, then it's a risk-free portfolio. A risk-free portfolio generates risk-free returns. So the future value, if it is 385, the present value in considering risk-free rate is 378. If 378 is the present value of the portfolio, we already know that the present value of portfolio is minus 5.5102 into 840 minus C. So we are equating both. So C will be 0.5102 into 840 minus 378.074, or C is equal to, I'll do this M plus 0.5102 into 840 is equal to 428. That is 428.568 minus 378.074, 50.49, 493. Here is the risk neutral method. P is equal to e power RT minus d by u minus d. So this will be 1.0202 minus d. What is down value? Minus 0.9 divided by 1.25 minus 0.9. So where did I get this? I got all of this from here. We already did all of this. 90%, 125% and all of that. Okay. So what you get is 1.0202 minus 0.9 divided by 0.35. You get probability as 0.3434. So 1 minus p is equal to 0.6566. Okay. So this is probability of up move. This is probability of down move. Okay. So value of option is equal to present value of expected value of payoffs. That is equal to 1.0202 0.3434 into 150 minus 0. 0.3434 into 150 is equal to 51.51. 1.0202 is equal to 50.49. 50.490 or 491. So you see here also I've got the same answer, here also I've got the same answer. Now if you look at our RTP, right, they have got a slightly different answer. Why? I'll tell you. Here instead of taking 0.3434, they took 0.34. Did they say anything about decimals in this question? They said round off to 2 decimals. See, I missed that. Very, very important point. Round off everything to 2 decimals. If you round off everything to 2 decimals, what will happen? 0.34 into 150 by 1.0202. So 0.34 into 150 divided by 1.0202. You'll get 49.99. You see? Rounding off gives such a big impact. And same way here also. If you round off stuff, right, you'll get a very, very different answer. So if you look at this, 0.5102, right, 150 by 294 gives 0.5102. So you take this as 0.51. If you take this as 0.51, 0.51 into 1050 minus 150. So you get 385.5. Now this 385.5 instead of 385.71. Now what is the present value of this 385.5? So what is the present value of this? Present value is 385.5 divided by 1.0202. Is 377.88. Okay, 87. Okay, 87. This 377.87. What is the value of this portfolio? 0.51 into 840 minus 377.87. Okay, 0.51 into 840 minus 377.87. You're getting 50.53. You see, there's a small, what you can say, rounding off related issue. So here also, when we did it with 4 decimals or 3 decimals, we got 50.49. When you did it only with 2 decimals, you got 49.99. So there is going to be this small error because of rounding off. See, even here also, if we did with 2 decimals, we did not get the exact number. From 0.49, it changed to 0.53. So when you do this round off business, you will always have this problem. That is why you should do exact 2 decimal round off is too fine. I mean, 2 decimal round off is not actually fair. So values, if they both are same, okay, if you follow this 2 decimal round off, you ideally should get the same answer. Values under binomial option values and risk neutral are same except for rounding off errors. At approximately 50.5 and 49.99. Okay, this is the thing. Now in exam, see, in RTP these fellows did a very bad job, because instead of doing this delta hedging method or portfolio application method, they went and did e power RT wala method. So if you recall, as I was telling you, that particular question, no, is actually from ICA question paper November 23. It is not May 24, it is November 23, where they completely, anyone who solved any other way other than what was prescribed in the suggested answer did not give marks. So forget this RTP. Please stick with the November 23 question paper where they have given it the correct way. Use only that way. And when you get these small errors, don't get worried. Please actually solve them as per what is determined in or as per what is given in the suggested answer. Ignore this particular RTP for this solution because this RTP solution is all chaotic. Okay, now let us move to, if you have any doubts, go to P600 plus, go to this question number 35 in derivatives options illustration. You will find it there. It is anyway there in November 23 question paper and suggested answers, of course. Let us move to the next one. Interest rate risk management. This is the next question. Suppose a dealer quotes all-in cost for generic swap at 6 months against at 8% against 6 months SOFR. SOFR is secured overnight financing rate, flat. If the notional principal amount of swap is 500,000, calculate semi-annual fixed payment. First floating, calculate semi-annual fixed payment. Okay. Find the first floating payment for one above. If the 6-month period from the effective date of the swap to the settlement date comprises 181 days and that of the corresponding SOFR was 6% of the effective date of the swap. If the settlement is on net basis, how much would you pay? Generic swap is based on 30 by 360. Round of the calculations to nearest whole number. Okay. Now, this is a question which requires more reading. I cannot just directly dump into the answer. Let us look at this. First, I'll add some pages. Okay. Let us look at this solution. Okay. What is the first thing? First, you are supposed to calculate semi-annual fixed payment. See, you are doing all-in generic swap for all-in cost for generic swap at 8% against 6-month SOFR flat. Notional principal is 500,000. P is equal to, or notional principal is equal to 500,000. Swap rate, swap fixed rate, 8%, and it is 30 by 360 basis for 6 month interest payments. What did they ask? First question, first semi-annual payment. First semi-annual payment is equal to 500,000 into 8% into 1 by 2. If it's a 40,000, that's 20,000. $20,000. Very simple. Okay, next coming to the second question. What is the second question? First, find out first floating rate payment. See, this is a dealer quote. Okay, there will be one fixed, one floating. So it is not about the company, it is not about what is fixed, what is floating, and all of that stuff. Right. So find out the first floating rate payment. If the 6-month period from the effective date of the swap to the settlement date comprises 181 days. Okay, 6-month period from the effective date of the swap to the settlement date, 181 days, and the corresponding SOFR was 6% on the effective date of this swap. So on the beginning it was 6%, whereas fixed payment is 8%. So fixed rate is equal to 8% and SOFR is equal to 6%. Okay, then what is the first floating payment? So floating payment is equal to, see here, floating payment, will you again do 30 by 360 or will you do 181 days? They have said 181 days. Will you follow this 181 days logic or will you follow the 30 by 360 logic? You will follow 181 day logic, which is 500,000 into 181 by 360 into 6%. 15,083.33. 15,083.33. What is the third part of the question? In the above, the settlement is on net basis. How much will fixed rate payer would pay to the floating rate payer? Net settlement is equal to 20,000 minus 15,083.33. That is equal to 4,916.67. Okay, 4,916.67. Very simple question only. I mean, first time when I read, I was wondering what is it. The whole trick is in this 181 days. Why are we taking only 181 days? See, the point is, see, ideally for that 6 months also, they should have calculated on 30 by 360. But here they have said, it comprises 181 days. So this is the indication that you have to use that 181 days there. Whereas with respect to the fixed rate payer, it would be 8% only for half a year, whereas for variable rate payer, it will be 6% for actual number of days. Okay, slightly twisted and weird, but anyway, that is what it is. Okay, now let us go to the next problem, portfolio management. Following information is available with respect to AK. Average share price, this is a brilliant question. Average index, dividend yield, return on government bonds. Compute beta value of the company at the end of 25. What is your observation? Round off everything to 2 decimals. Now, what is beta ka formula? There are 3 or 4 formula. If you recollect, I gave you not 3, I think 3, yeah, not 4, 3. Okay, so first let us see. They have given average share price, dividend, and average dividend yield. One of them is dividend, other one is dividend yield. So please don't get confused. And they said return on government bonds. So if you look at this, 6, 5, 4, 5. So average of this works out to actually 5. Okay, 6 plus 5, 11, 11 plus 9, 20, 20 by 4 is 5. Okay, so solution 2022. Okay, now we have average. We don't know what is the return of the share. So you have to find out the return of the share, but when you find out the return, you don't know what is opening closing. So you have to assume one of them as opening, other one as closing. So what you do is 2023 opening, closing, dividend, return. This is for share. 242, 279, 279, 305, 305, 322. What is the dividend? Dividend is, now do you take the one above or one below? So in 2023, what is the dividend that you have received? You would have received 25. So you have to take this only. Then 30 and then 35. What is the return? Return is equal to closing plus dividend divided by opening minus 1. So 279 plus 25 divided by 242 is equal to minus 1 is 25.61%. They said 2 decimals, right? 25.62%. Then 305 plus 30 divided by 279 minus 1 is equal to 20.07%. Okay, 20.07. Then 322 plus 35 divided by 305 minus 1, you get 17.050, 049, so 05%. Okay, these are the share returns. Now let us come to the index return. What is index return? What is index return? Same logic again. 195 plus 1950 plus 5. So 2023, 2024, 2025, closing, opening, and you have dividend yield. Please don't take directly as dividend. This is dividend yield directly in percentage. Okay, so return plus yield. Yield is 5, 6, and 7. I'll write this as 5, 6, and 7. This return we have to compute. What is opening and closing? 1950, 1812, 2258, 2220. Okay, so what is the return? 1950 by 1812 minus 1 is equal to 7.6% plus 7.62%, okay, plus 5%, that is equal to 12.62%. Then 2258 divided by 1950 is equal to minus 1 is equal to 15.79. Plus 6 makes it 21.79%. 2220 divided by 2258 is equal to minus 1 is equal to into 100 is equal to minus 1.68% plus 7, you get 5.32%. Okay, this is the index return. Okay, then we have to compute beta. Beta, we have two formulae. One is n sigma xy minus sigma x sigma y by n sigma y square minus sigma y whole square. This is one formula. Other formula is sigma xy minus n x bar y bar divided by sigma y square minus ny square. Okay, we can use either of these two formula. Now which one looks simpler and easier for us? xy anyway we have to do, x bar y bar we can do y square. So now you have to first tell me what is x, what is y, what is dependent, what is independent. So if you look at this, the market, see in this particular thing, no, don't get into this confusion of y is equal to mx plus c, where this is the security and this is the market. No, that is only for you to understand the slope equation. Don't bring that logic into this. Here y is market, so this is basically market, okay, and x is basically the security. So you have to find out, use x as security and y as market. Please don't forget, this is a very, very important thing. Now you can use either of these methods. Which one looks simpler? I think the first equation only looks simpler. Okay, so x y square and xy. Okay, x is security, y is market. Okay, what is security ka return? 25.62, 20.07. I am ignoring the percentages. Eventually I will add 25.62, 20.07 and 17.05. And y is what? 12.62, 21.79, 5.32. Okay, so 12.62 into is equal to 159.26. They said 2 decimals. 21.79 into is equal to 474.80. 5.32 into is equal to 28.30. Then xy 25.62 into 12.62 is equal to 323.32. 20.07 into 21.79 is equal to 437.32. 17.05 into 5.32 is equal to 90.70. Now sigmas, right? We need sigma x, y, sigma x, sigma y. Sigma x, all of them I think we need sigmas. Sigma y square, okay, sigma y whole square. Okay, anyway we'll do this. 25.62 plus 20.07 plus 17.05 is equal to 62.74. Then 12.62 plus 21.79 plus 5.32 is equal to 39.73. 159.26 plus 474.80 plus 28.3 is equal to 662.36. 323.32 plus 437.32 plus 90.7 is equal to 851.34. Now, okay, now beta is equal to n into sigma xy, that is 3 into 851.34 minus sigma x, sigma y. What is sigma x, sigma y? 62.74 into 39.73 divided by n sigma y square, 3 into 662.36 minus sigma y whole square, 39.73 whole square. So this will be denominator. First I'll do 662.36 into 3 is equal to m plus 39.73 into 39.73 is equal to 1578. So I'll do this m minus. So I'll get memory recall 408.61, numerator 62.74 into 39.73 is equal to m plus, and 851.34 into 3 is equal to m plus. Memory recall, so I did ulta. 62.74 into 39.73 is equal to m minus, and 3 into 851.34 is equal to m plus. Memory recall 61.36. So 61.36 divided by 408.61, you get 0.15. So what is the question asking? The question is very, very specific. I scrolled it down, that's why I'm checking. Question is very, very specific. round of 2 decimals, compute value of beta as at end of 2025. What is your observation? What is observation? Beta is low. Is low. Implies low systematic risk and return and high unsystematic risk. Okay, so low systematic and high unsystematic. So returns of stock do not vary with market returns. Okay, this is done. Next, ICL, this is international management question. ICL, Indian MNC, is executing a plant in Sri Lanka. It has raised 400 billion rupees. Half the amount will be required after 6 months' time. So first half is not required now. ICL is looking at an opportunity to invest this amount on 1st April 2020 for a period of 6 months. Okay, it's considering two proposals: Japanese index fund and US T-bills. We have done similar problem, but it was not in international financial management. I think we did this in forex. Okay, dividend in billion 25. Which currency is this? Acha, this is JPY billion. Okay, income from stock lending 11.9276. This is also billion. Discount on initial investment at the end 2%. Interest is, this is a separate column. Interest is 5% per annum. Exchange rate on 1st, exchange rate on 30th September. Various currencies are given. Now what? You as an investment manager, required to suggest the best course. Present all figures in billion. Round of calculation to 4 decimal places. Billion. Horrible billion nonsense here. I hate this billion nonsense. Anyway, let's move forward. Most comfortable with lakhs and crores. Million, billion is a nuisance and nightmare. Okay, you have to be very careful. Let us look at this. So you are supposed to compare these two. Okay, you have some money, surplus money you want to deploy. You can deploy either A or B. Compare which one will give you better returns, considering the forex risk, considering the interest rate return, considering the any other dividend or whatever they get. Okay, so first solution. Investment in JPY. Okay, how much is it? 400 billion, half of which. So amount available 200 billion rupees. Okay, on 1/4/20. Okay, and exchange rate. I put this red line here, 1.58. JPY INR 1.5. What does it mean? See here also USD INR 0.014. That is number of USD per INR. Here also number of JPY per 1 INR. So into 1.58 JPY per 1 INR. This is the logic. Moment you see USD INR, no USD by INR. This is what I hate with the institute. Each time they will come up with their own interpretation. Once they will say USD INR is USD's base currency. Here USD INR is the base currency. They themselves don't have clarity, and they expect students to have full clarity on everything. Okay. Anyway, 4 decimal places. So this will give you how many JPY? 200 into 1.58. 316 billion JPY. Okay, you convert this and invest in JPY. Now when you invest, you're going to get how many billion dividend 25 billion. Dividend 25 billion JPY. Okay, then you get what? Income from stock lending 11.9276. Stock lending income 11.9276. Okay, JPY billion, please note. Then less discount on initial investment. So when you sell it off, you don't get the same value. That is 316 into 2%. 2% is what they said. No, and please note, you have to compute the discount in JPY terms, not in rupee terms. Okay, 2%. So when they sell off, they are going to sell it off at a discount of 2%. So 316 into 0.02. You get 6.32. This is a reduction. Okay, so now 316 plus 25 plus 11.9276. I'm always confused. 9276 only, no? Yeah, 9276 minus 6.32. It gives you 346.6076 JPY billion. Now this is the value at as on 30th September. Now convert to INR at the rate of 1.57. 1.57 JPY per INR. Okay, so you need JPY to be cancelled, so you should do divide by. So INR receipt is equal to 346.6076 divided by 1.57. This is JPY, this is JPY by INR. So INR will go here, JPY cancel, get answer in INR, divided by 1.57. So you get 220.7692 billion rupees. Okay, this is what you will get. This is the money that you will get back in rupee terms if you go with the first alternative. Now let us go with the second alternative. What is the second alternative? Second alternative is this, treasury bills. You directly invest in treasury bills. Amount in INR 200 billion INR, USD INR rate 0.014 or 0014. What is it? Single zero only. No, thankfully single 014 USD per INR. So you can directly multiply these two and they'll get cancelled. 200 into 0.014, you get 2.8 billion USD interest at the rate of 5%. No, it is not per annum. Please no, it is per annum. So whereas you invested for 6 months only, at the rate of 5% per annum. So into 0.025, that is 2.5%. So you get 0.07 billion USD as interest. So total 2.87 billion USD. Convert to INR at 0.013. That's what they said, right? 0.013 USD per INR. So you have to divide 2.87 divided by 0.013 USD per 1 INR. This is USD gets cancelled, INR goes on the top. So 2.87 divided by 0.013, you get 220.7692. Okay, what did you get? You got both places same thing. In fact, this is 791 or something. This is actually 9230. So USD is a better option. Why? Invest in USD as these are, as the return is same, and USD government bond, treasury bills, treasury bonds, what do they call them? Treasury bills and USDT bills are safe than JPY stocks. This is the answer you're supposed to give. If you don't write this sentence, gone, marks are gone. You be very, very careful. We have done multiple questions. I think we have done 2 questions like this in the class. Okay. Next. What is the next one? This is M&A question. Long Limited is planning to acquire Tall Limited. Okay. This is the acquirer. This is the target. I told you multiple times, write like this. With the following data available for the companies: expected EPS, expected DPS, number of shares, current market price of the share. Okay. As per an estimate, Tall Limited is expected to have steady growth of earnings and dividends to the tune of 6% per annum. Okay, target is going to go 6%. However, under the new management, growth rate is likely to be enhanced to 8% without any additional investment. Okay, no problem. You are required to calculate the net cost of acquisition by Long if 60 is paid for each share of Tall. This is the first one. If the agreed exchange ratio is 1 share of Long for every share of Tall in lieu of cash acquisition as per 1 above, what would be the net cost of acquisition? Calculate gain from acquisition. So this whole net cost of acquisition and gain from acquisition business now is very confusing. A lot of students get confused. In fact, when I teach also, I am very, very careful that this is what they mean. Okay, because the institute has gone completely crazy in trying to define something called as net gain or net cost of acquisition. So please pay very, very close attention to what we are discussing here. They have specifically asked this in this RTP, so there is a high potential that something like this could come up in the exam either this attempt or next attempt, because this is a very twisted, convoluted, dirty kind of concept that the institute has somehow managed to creep into the material and then claim arbitrarily either left or right as the answer. Okay, once in a while they say this is the answer, once in a while they say that is the answer. Very, very weird. Anyway, let's move forward. Now, what is that they are saying? First, we are supposed to value Tall. Right, net cost of acquisition by Long if 60 is paid for each share of Tall. Now you see, dividends are supposed to grow a steady growth rate of 6, but they may be enhanced to 8 without any additional investment. Cost is equal to what is paid minus what is value. So this is 60, and what is the current market value? Current market value is already known as 50. So you have paid 10 extra minus 50. So 10 per share. How many shares? Shares of tall. 18 lakhs. So total shares, total cost 1.8 CR, that is 18 lakhs into 10. Okay, this is the first part. Now come to second part. If the agreed exchange ratio is of 1 share for every 3 shares in lieu of cash as per 1 above, so instead of 60 rupees cash, you are saying that we will exchange the ratio of 3:1. What will be the net cost of acquisition? Cost of acquisition if 3 shares of tall are exchanged for 1 share of long. See, share of long is equal to 180, right? Share of tall is equal to 50, correct, no? Yeah, 180 and 50. 3 shares of tall is equal to 150. So you are giving a 180 rupee worth share and getting only 150 rupee worth shares. Okay, cost is 180, value received is 150, net cost is 30, and how many shares? How many shares are you issuing like this? See, you are giving 30 of your per share of yours that you have issued, you've lost 30 bucks. But how many shares have you issued? So the number of shares is 18 lakhs and 30 lakhs. So we issued 18 lakhs by 3. Shares issued is equal to 18 lakhs divided by 3, that is 6 lakhs. Total cost of acquisition or net cost of acquisition is equal to 6 lakhs into 30, that is 1.8 crores. Same thing. This is the same answer. Now they have given an alternative solution also, which I fully don't agree with. Okay, so I am going to ignore that alternative solution. It is not proper. Then finally, what is they say? What is the gain from acquisition? Now, so far we have found out cost of acquisition. What is the gain? So how will you get a gain? Gain from acquisition. And see, this gain from acquisition also, is it for part 1 or is it for part 2 or is it for both put together? See, on the plain reading, right, it appears clearly it is from part 2 only. It is not for part 1. So if in part 2 you have exchanged some shares and all of that, what is the gain that is going to accrue to you? Now this gain, no, are you going to look at this gain from, what is the value of shares given up versus what you are going to future may receive? Or are you going to look at it in the form of, is there an increase because of PE ratio may the value, market value of the shares is increased? Is that one way to look at it? So these guys in this particular question have chosen to look at it from PE method, PE increase in, value of the company. That is one way. See, they have given also the growth rates of dividend and all of that. Okay, so you can potentially use that method also to find out. Okay, so there are various ways in which you can do, but in this particular RTP, they have chosen to go by this one method, which is gain from acquisition due to higher PE. Is there a higher PE first of all? What is the data that I have here? Long, tall, acquirer, target, EPS 12 and 5, current market price 180 and 50, PE is 15 and 10. Okay, now shares issued. How many shares? We said 1:3, right? So for 18 lakhs, 6 lakhs were issued. 6 lakhs, and these guys have existing 30 lakhs, right? Now total shares 36 lakhs. Okay, then PAT. What is PAT? EPS into shares. This is 30 lakhs into 12, that is 3.6 crores, and 6 lakhs into 5, that is 30, not 6 lakhs. Original share count was what? 18 lakhs. 18 lakhs into 5, which is 90 lakhs. So total is 4.5 CR is the PAT. For against how many shares? 36 lakh shares. So revised EPS is 4.5 CR divided by 36 lakhs. So you can do 450 divided by 36. Revised EPS is equal to 12.5. Original was what? 12 and 5. Now you got 12.5. Now revised EPS is 12.5. New PE is how much? PE will take 15. Revised share price is equal to 12.5 into 15. You get 187.5. Now what is the very specific question? Calculate the gain from acquisition. That's all. They didn't get into the details of anything else. So you have to simply take this value only. Right. Revised share price. New share count is 36 lakhs. New value or new combined market cap is equal to 36 into 187.5. 36 into 187.5, you get, this is what? This is rupees and 36 is lakhs. So you get 6750, that is 67.5. That is, you get 67.50 crores is new market cap less old market cap. Old market cap was how much? Old market cap was 30 lakhs into 180 and 18 lakhs into 50. Long 30 lakhs into 180, tall 18 lakhs into 50. This is 54 crores and this is 9 crores. So this is 63 crores. So the gain is 4.5 crores. Gain from acquisition is 4.5. Now this again is a slightly weird thing. Wherever you use the 6%, 8%, we have not used. They have given some alternative solution in which they have used, but I don't fully subscribe to that. It is very. Let us go to the next problem. Mutual funds. Okay, now let us go to the next question. This is a question from mutual fund chapter. On 1st April, an open-ended scheme of mutual fund had 400 lakh units outstanding with NAV of 19. We have done similar problems. At the end of April, it issued 5 lakh units at opening NAV plus 2% load adjusted for dividend equalization. At the end of May, 4 lakh units were repurchased, opening NAV plus 2% load. Then at the end of June, 60% of income was distributed in respect of June quarter. Following additional information is available. Portfolio value, appreciation each month. You are required to calculate income available for distribution. Issue price at end of April. Repurchase price at end of May. NAV is on 30th June. Round of all calculations up to 4 decimals. This kind of problems, I don't know what value they add. This whole dividend equalization concept itself is gone, but our institute keeps asking questions unnecessarily on this stupid concept and torturing students. That's all, nothing else. It's a very simple question. If you have practiced this chapter well, this question was asked, I think it was asked in September 25 or May 25 also. Okay, it's a simple question only. It is just that computation heavy. There is more of arithmetic and calculator usage than anything else. Income available for distribution. See, first of all, what do you have to do in this question? I'll open the question here. Now, let us look at this question. What are the things that are required? One is NAV, repurchase price, issue price and income for distribution. The first three things are now interlinked together. Fourth one is an outcome. Okay, so income for distribution, opening units, lakh and NAV, opening is 400 lakhs, NAV is 19, okay. Then what do? At the end of April, it issued 5 lakh units at opening NAV of plus 2% load adjusted for dividend equalization. So first let us add income for April. What is income for April? 31.96. So total 31.96 for 400 lakh units. So 31.96 divided by 400, you get 0.0799. So total value is for same 400 lakh units, it is 19.0799. Okay, this is the first part. Now, what are you doing? Issue fresh units, issue new units, right? What NAV are you issuing? See, you are issuing it at your 19 plus dividend equalization plus 2% load. So this 2% load is a different story, but April issue price opening NAV 19, entry load 2%, 2% of 19 is 0.38. Add dividend equalization. What is dividend equalization? Because there is a dividend of this much, this fellow, whoever is coming in, is also has to pay this much. So 0.0799, 0.0799. So if you add all of this, 19 plus 0.38 plus 0.0799, you get 19.4599. This is the issue price. For how many lakh units? This is for, you are issuing 5 lakh and they are at 0.0799. For them also money comes in. So 5 into 0.0799 will give you 0.3995. So if you add these two, what is the overall income available? 0.3995 plus 31.96. So you get 32.3595. Okay, this is the income available. What is the May income? May income is 46.1250. Now 46.1250 is for how many lakh units? 405. So entire 405. So 46.1250 divided by 405, you get 0.11388. So I'll take it as 39. Now this is for entire 4 lakh units. This is the income. Now your repurchase. When you repurchase, how many you are repurchasing? I think 4 lakh units. Yes, you are repurchasing 4 lakh units. Now May repurchase. Opening NAV 19. Exit load. Please note exit load is subtracted. So minus 0.38. Add dividend equalization. You have to pay them dividend equalization. What is this dividend equalization value? This is this income plus this income. So what is the total value here? Whatever is the value, whatever is the dividend that is earned over these two periods, you have to consider that. So 0.0799 plus 0.1139. This is what you have to consider. So if you add these two, right, in fact, you get 0.1938. 46.1250 plus 32.3595 is 78.4845 divided by 405. You get 1.1938, correct. For this 4 lakh units, you have to pay this off. Okay. So when you pay this off, what is left? 401, this 405 I will write, and then total, and then repurchase. Repurchase 0.1938. So 0.1938 into 4 gives you how much? So minus 0.7752. So what is the income available now? Minus plus 78.4845. So income available now is 77.7093. This is at the end of May. Now what is the dividend equalization that you paid? 0.1938. 0.1938. This is plus, this is minus. So 19 minus 0.38 plus 0.1938, you will get 18.8138. This is the repurchase price. Here so far this is okay. So we have answered question 2 and 3. Now question 1, how much is the income available for distribution? That is what is the question, right? Right. Now June. This is 401 units. June income. How much is the income for June? 58.47. So 58.47. Okay. 58.47 divided by 401. So you get 0.1458. Okay. So total value is for 401 units 0.1458 plus 0.1938. No, 0.14. Total value is 77.7093 plus 58.47. You get 136.1793 divided by 401. You get 0.3396. So if you add these two, you get 0.3396. So okay. So this is the income available for distribution. Income for distribution. Then how much is distributed? They said 60% distributed. So out of this 60% is paid. So 136.1793 into 0.6, which is 81.7076. See, everywhere else we did took the per unit value. Here we are suddenly doing on an overall basis. 81.7076 divided by 401. And 0.2038. So for 401. So what is the net available? 136.1793 minus 81.7076. 54.4717. This is the net money available. Now we have answered 3 questions. No, income available for distribution and done, issue price done, repurchase price done, NAV. Now what is NAV? NAV is equal to opening value plus appreciation plus income left. What is opening value? Opening value we had 400 into 19. No, but you have 401. No, opening value you had 400 into 19. 19 fours are 76. So 7,600 lakhs. Appreciation, the value of the portfolio is how much? 515.67. 515.67. The appreciation is 515.67. Then you should not make one mistake, which is, sir, we have already got directly here 54. No, is that is the money that is left? No, but please note, this includes the money that you have collected from these fellows for dividend equalization. So if you are going to take this as a value, you have to adjust for dividend equalization. If you don't take this, then you need not adjust. So I'll tell you what I mean. So let us take incomes. What are the incomes? 31.96 plus 46.125 plus 58.47. Okay, these add up to how much? 31.96 plus 46.125 plus 58.47. It adds up to 136.555. What is the dividend that you paid? Dividend is very clear, 81.7076 less dividend, 81.7076. Now you have taken direct incomes. You have not taken the dividend equalization here. You have not collected that, right? You have not taken. So now you take that into account. Whereas in this computation, dividend equalization value is already considered. So which is why if you take this, you have to if you take the value here, you cannot take dividend equalization value here. So that is why be very, very careful. So what happens? Add money on new issue less repurchase. How many units? New issue is 5, this is 4, 4 into 18.8138 and 5 into 19.4599. So 5 into 19.4599 is equal to 97.2995, then 4 into 18.8138 minus 75.2552. So what is the total? All the values have come in. The dividend equalization value, the entry load, exit load, everything has been considered here. 7,600 plus 515.67 plus 136.555 minus 81.7076 plus 97.2995 minus 75.2552. You get 8192.5617 for how many lakh units? 401 lakh units. So you divide by 401. So you get 20.4303 per unit. See, if you look at the RTP, they've got a slightly different answer. That is because they rounded off this 19.4599 to 4600. I didn't round off because they specifically said you 4 decimals. Okay, so and this 0.0799 is not a round off number. Okay, if you look at it, 31.96 divided by 400, 0.0799, there is no 5th decimal there. So that is why I took like that. So you'll get I don't think they'll cut marks if you actually give a more accurate answer rather than rounding off, because they specifically said round off till 4 decimals only. Okay, nuisance question. I actually hate this question. Anyway, this is also another hateful question. Security analysis. Closing values of NSC from 8 to 21st are given below. NSC, okay, data is given. Given detailed analysis based on your calculations of 21-day exponential moving average of Nifty during the above period. The previous exponential moving average of Nifty can be assumed 26. Round off calculations up to 3 decimals. Okay, now they are saying give detailed analysis on the basis of calculation of EMA. So they want you to calculate EMA. What is EMA ka formula, boss? If you recollect, what is the formula for EMA? EMA is equal to closing price minus EMA of previous day whole thing into exponent plus previous day EMA. Okay, now what is this exponent value? What did they say exponent? 21-day exponential moving average. The previous day can be assumed, round off to 3 decimals. What is the exponent value? Acha. So exponent is equal to 2 by n plus 1. So that is 2 by 21 plus 1, that is 2 by 22, that is 1 by 11, that is 0.0909. 0909. How many decimals did they say? 3 decimals. So 091. Okay, this is the exponent. Now for every day you have to compute. So I will keep my thing open here. Day is 8th, no? First one is 8th only, right? Date is 8th. Okay. 8, 9. Till how many? We have 21 days, right? No, but we don't have working all days also. 8, 9, 12, 13, 14, 16, 19, 20, 21. 8, 9, 12, 13, 14, 16, 19, 20 and 21. This is the dates because we don't have the non-working days, we need not compute. Okay. Then we have to take Nifty value. What is Nifty value? Nifty value for that day is 25,877. Then you have 25,683, 25,790, 25,732, 25,665, 25,694, 25,585, 25,232, 25,158. This is the Nifty value. For this Nifty value, you know the Nifty value, but you need to compute the exponent value. Exponent you have it here, but you also need the previous day EMA. Previous day EMA for first period. For first day, what is the thing they said? 26,024. 26,024. From then on, you will actually compute the EMA. Then I'll call this as 1, I'll call this as 2, 1 minus 2. How much? 25,877 minus 26,024. You get minus 147. Then 3, this is 3. 3 into 0.091 into 0.091 is minus 13.377. This is 4. 4 plus 2, correct? 4 plus 2. So plus 26024. You get 26010.623. Okay, nuisance. Chat. Horrible thing. 26010.623 minus 25,683. So you will get minus 327.623. I hate this, man. Into 0.091 minus 29.814. 26010.623 minus 29.814. 259.80.809. Okay, minus 25,790. Minus 190.809 into 0.091 is equal to minus 17.364. So 259.80.809 minus 17.364, you will get 25963.445. 25963.445 minus 25,732. So you get minus 231.445 to 0.091. You get minus 21.06, 3 decimals, no? 061 and 25963.445 minus 21.061 is equal to 25942.384. 25942.384. So 25942.384 minus 25665 minus 277.384 into 0.091, you get minus 25.2419, so 242. So minus 25.242 plus 25942.384 is equal to 25917.142, 25917.142 minus 25694 minus 223.142 into 0.091, you get minus 20.306. Okay, 25917.142 minus 20.306 is equal to 25896.836. Then 25896.836 minus 25585, you get minus 311.836 into 0.091, you get minus 28.377. So 25896.836 minus 28.377 is equal to 25868.459 minus 25232 is equal to minus 636.459 into 0.091 is equal to minus 57.918. 25868.459 minus 57.918, 25810.541 minus 25158 minus 652.541 into 0.091 gives you minus 59.381. So 59.381 minus plus 25158, sorry, plus 25810.541, you get 25751.16. Okay, now this is done. Such a painful lengthy calculation. What did they say? Give detailed analysis based off EMA, previous day exponential so and so, round off calculation. What is a very great DNA EMA analysis? What is a great thing? EMA is continuously moving down. 26, 25, 980, 960, 940, 917, 890, 860, 810, 751. EMA is giving bearish or negative signal. So sell or short. That's all. There's nothing major beyond this. Okay, next, explain key decision falling within the scope of financial strategy. Explain risk associated with the use of blockchain. This I've been telling you very, very clearly, very important. Explain the characteristics of venture capital financing. So key decision falling within the scope of financial strategy: financing decision, investment decision, dividend decision, portfolio decision. You have to answer about all four. Okay, you have to give, you need not give, see, because it's a 4-mark or question, you need not elaborate on each one of them very, very carefully. Financing is mix of equity, debt. Investment decision is whether you're, how will you invest in long-term projects, how will you evaluate the risk and return, because you don't know certainty. So basically investment decisions is what? NPV, you use various methods. Dividend decisions, how do you pay, what is the ideal dividend payout ratio. Then portfolio decision, this involves evaluation based on the contribution to aggregate performance rather than isolated characteristics. So you look at it as a portfolio basis. Then associated risks with the blockchain, they need to consider risks from different risk. Different people have different risk appetite. Reliability of transactions depend on underlying technology, it can be tampered. Absence of central authority will difficulty to administer amendments and all that, and it involves a lot of data. Risk related information overload could challenge the level of monitoring. So these are basic risks. We have discussed this in the class, or you can go through. What are the characteristics of venture capital financing? Long-term horizon, lack of liquidity, high risk, equity participation. If you write 4, it is sufficient. In their answers itself, they are giving 4, it is more than sufficient. If you write any of the 4, there are others also, right? So long-term horizon, lack of liquidity, high risk, and equity participation, these are the risks. So this concludes the entire RTP for May 26. Okay, quite a few dirty questions, quite a few questions where they made mistakes in their own RTP, quite a few questions where there are multiple answers possible, so on and so forth. But please be very clear, you have to go through RTP for last 2 to 3 years for you to be prepared very well for your May 26 exams. Study well and all the very best.